Today, we will talk about how a currency swap works. A currency swap, sometimes called a cross-currency swap, is when interest and sometimes principal are exchanged in one currency for the same in another currency. This exchange takes place at fixed dates throughout the life of the contract and is considered a foreign exchange transaction. It's usually not required by law to be shown on a company's balance sheet. Currency swaps were originally used to bypass exchange controls, governmental limitations on currency purchase and sale. Nowadays, they're mostly used to hedge long-term investments and change the interest rate exposure of the two parties. Companies doing business abroad often use currency swaps to get more favorable loan rates in the local currency than if they borrowed money from a local bank. In a currency swap, parties agree whether or not to exchange the principal amounts of the two currencies at the onset of the transaction. This creates an implied exchange rate. For example, if a swap involves exchanging 10 million euros versus $12.5 million, that creates an implied euro to US dollar exchange rate of 1.25. At maturity, the same two principal amounts must be exchanged, which creates exchange rate risk as the market may have moved far from 1.25 in the intervening years. Pricing is usually expressed as LIBOR, plus or minus a certain number of points, based on interest rate curves at inception and the credit risk of the two parties. There are three variations on the exchange of interest rates: fixed rate to fixed rate, floating rate to floating rate, or fixed rate to floating rate. Interest rate payments are usually calculated quarterly and exchanged semi-annually, although swaps can be structured as needed. Interest payments are generally not netted because they are in different currencies. Here are 4 key takeaways. 1. A currency swap involves the exchange of interest, and sometimes of principal, in one currency for the same in another currency. 2. Companies doing business abroad often use currency swaps to get more favorable loan rates in the local currency than if they borrowed money from a local bank. 3. Considered to be a foreign exchange transaction, currency swaps are not required by law to be shown on a company's balance sheet. 4. Interest rate variations for currency swaps include fixed rate to fixed rate, floating rate to floating rate, or fixed rate to floating rate. Hope this would help. Thanks for watching.